Let me tell you about two investors who made the exact same decisions. ETFs, same dividend stocks, same amount invested every single month, same drip settings, same 20-year time horizon. After 20 years, one of them had $412,000. The other had $297,000, $115,000 difference. They did not pick different stocks. They did not have different incomes. They did not have different strategies. Only difference between them was 4 letters. ROTH. And in the next 12 minutes, I am going to show you exactly what those 4 letters mean, why the account you put your dividend investments into matters more than almost any other decision you will make as an investor, and the specific setup that maximizes every dollar you put into this market. With me. Because this is the video most people find 2 or 3 years into their investing journey, wishing they had seen it on day one. This video is for you if you are already investing in dividends or about to start, and you have not yet figured out the account question. Roth IRA or regular brokerage account, or maybe both. By the end of this video you will have a clear answer, not a vague "it depends." A specific setup, what to open, what to put where, and in what order based on where you are right now. At the very end I will give you the exact account priority order that most financial educators only share with paying clients. A simple 3-step sequence that tells you exactly what to fund first, second, and third. Quick note, this video is for educational purposes only. I am not a financial advisor. Nothing here is personalized financial advice. Always do your own research before making any investment decision. Here is what we will cover. First, what a Roth IRA actually is and why it is the single most powerful account available to American dividend investors. Second, what a regular taxable brokerage account is when it makes sense and what its real limitations are. Third, the ultimate dividend setup. What goes where and why. Let's go. Before I get into the comparison, I need to make sure you understand one foundational concept, because everything in this video builds on it. That concept is tax drag. Tax drag is the invisible force that slows your portfolio down every single year, and most beginning investors have never even heard the term. Is how it works. When you hold dividend investments in a regular taxable brokerage account, every dividend you receive is a taxable event. The IRS wants their cut, every quarter, every year, for as long as you hold the investment. If you earn $1,000 in dividends, and you are in the 22% ordinary income tax bracket, you owe $220 to the IRS before you can reinvest. So instead of reinvesting $1,000, you reinvest $780. That $220 difference does not sound catastrophic in year 1. Compound it over 20 years and the annual tax drag costs you tens of thousands of dollars in lost compounding. This is the invisible leak in most beginner dividend portfolios. The money they are losing is money they never see because it goes to taxes before it ever hits their reinvestment. The Roth IRA eliminates this leak entirely. Every dividend you earn inside a Roth IRA, 0 taxes. Every dollar reinvested, full compounding. No annual tax bill. No quarterly tax event. Nothing. That is the core of why this account matters so much. Okay, let us understand each account properly. The Roth IRA. IRA stands for Individual Retirement Account. The Roth version was created by Senator William Roth in 1997, specifically designed to allow Americans to invest after-tax dollars today in exchange for completely tax-free growth forever. Is how it works in simple terms. You earn money, you pay your regular income taxes on it. Then you contribute that already taxed money into your Roth IRA. Inside the Roth IRA, your money grows completely tax-free. Your dividends compound tax-free. Your capital gains accumulate tax-free. And when you withdraw in retirement after age 59.5, you pay 0 taxes on any of it. 0. Nothing. Not a dollar. Dividend investors, this is extraordinary. Because dividends, paid quarterly, year after year, for decades, would normally generate a tax bill every single year in a regular account. Inside a Roth IRA, that tax bill simply does not exist. The rules you need to know. The 2024 contribution limit for a Roth IRA is $7,000 per year. If you are 50 or older, $8,000 per year. There is an income limit. If you earn above $161,000 as a single filer, or $240,000 as a married couple filing jointly, your ability to contribute directly to a Roth IRA begins to phase out. If you are below those limits, you are eligible, and you should be using this account. Where to open one: Fidelity, Schwab, and Vanguard all offer Roth IRAs with no account minimum and no annual fees. Takes 10 minutes to open online. Now the regular taxable brokerage account. This is the account most people think of when they think of investing. You open it, deposit money, buy stocks or ETFs, and you are investing. No contribution limits, no income limits, no restrictions on when you can withdraw, complete flexibility. Here is the trade-off. Every taxable event, every dividend received, every profitable sale generates a potential tax liability. Qualified dividends, like those paid by SCHD or VYM, are taxed at preferential rates. 0% if your taxable income is below $47,000 as a single filer, 15% up to $518,000, 20% above that. Non-qualified dividends, like those paid by JEPI, are taxed at your full ordinary income rate, which for most working Americans is 22 or 24%. Taxable brokerage account is not bad, it is genuinely useful. But for dividend investors, especially in the accumulation phase, it is the second account you fund, not the first. If you are finding this more useful than anything else you have read about this topic, subscribe right now. A new video drops every other day and every single one is built exactly like this. One tap, that is all it takes. Now let me show you the real math on why account choice matters so much. Investors both invest $7,000 per year, which is the Roth IRA annual contribution limit, into a dividend ETF with a 4% yield and 8% total annual return. Investor A uses a Roth IRA, 0 taxes on dividends, full compounding every year. Investor B uses a taxable brokerage account, pays 15% tax on qualified dividends every year. Reinvests the after-tax remainder. After 10 years, Investor A Roth IRA portfolio value approximately $101,000. Investor B taxable account, portfolio value approximately $94,000. After 10 years, $7,000. After 20 years, Investor A Roth IRA portfolio value approximately $320,000. Investor B taxable account, portfolio value approximately $285,000. After 20 years, $35,000. After 30 years, Investor A Roth IRA portfolio value approximately $780,000. Investor B taxable account, portfolio value approximately $640,000. After 30 years, $140,000. $140,000. Not to bad stocks, not to bad timing, not to bad strategy, but to taxes on dividends that compounded quietly against Investor B for 30 years. This is tax drag in full effect. And this is why the Roth IRA is not just a nice-to-have. For a dividend investor in the accumulation phase, it is the most important account you can own. Now let me address the question I know you are already asking. If the Roth IRA is so powerful, why would anyone use a taxable brokerage account at all? 3 reasons. Reason 1. You have already maxed out your Roth IRA contribution for the year. $7,000 is the annual limit. Once you hit that, additional investments must go somewhere. A taxable brokerage account is the natural next step. Reason 2. You are above the income limits for Roth IRA contributions. If your income exceeds the eligibility threshold, there is a legal strategy called a backdoor Roth IRA conversion that allows higher earners to still access Roth benefits. But that is a more advanced topic for a future video. Reason 3. You need flexibility before retirement age. Money inside a Roth IRA is generally meant to stay there until you are 59 and a half. While there are rules allowing early withdrawal of contributions, not earnings in certain situations, the taxable brokerage account offers complete withdrawal flexibility at any time with no penalties. So the taxable brokerage account is not your enemy. It is your overflow account, your flexibility account, your second account. It is second. The Roth IRA comes first. Now let me show you the 2 scenarios side by side, and why each ETF belongs in a specific account. ST and VYM, which pay qualified dividends taxed at preferential rates, can work reasonably well in either account. But they reach maximum efficiency inside a Roth IRA, where even the preferential dividend tax disappears entirely. JEPI, which pays non-qualified ordinary dividends taxed at your full income rate, should almost never be held in a taxable account by a working investor. The tax cost is significant. JEPI belongs inside a Roth IRA where its high yield becomes genuinely powerful with 0 tax drag. High-yield ETFs and high-dividend individual stocks, anything generating substantial ordinary income, belong inside tax-sheltered accounts. Always. Lower-yield growth-oriented dividend ETFs, if you must hold them in a taxable account, are the most tax-efficient choice for your overflow investments. Match the investment to the account based on its tax treatment, not just on its yield. Now the account priority order I promised you at the start. This is the sequence most financial educators charge to explain. Here it is. Step 1. If your employer offers a 401k with a matching contribution, contribute enough to capture the full match first. This is an immediate 100% return on that portion of your money. No investment can beat it. Do this before anything else. Step 2. Max out your Roth IRA, $7,000 per year. Put your highest-yielding dividend ETFs here. Let them compound with 0 tax drag for decades. Step 3. If you have additional money to invest after steps 1 and 2, open a taxable brokerage account. Put your most tax-efficient dividend investments here. Lower yield, qualified dividend ETFs. Avoid high-yield ordinary dividend payers in this account. That sequence, 401k match first, Roth IRA second, taxable brokerage third, is the foundation of a tax-efficient dividend investing setup. It is not complicated, but most beginners never see it laid out this clearly. And the cost of not knowing it is measured in tens of thousands of dollars over a lifetime of investing. Let me recap everything fast. Tax drag is the invisible force slowing your dividend compounding every year in a taxable account. The Roth IRA eliminates it entirely. The Roth IRA gives you tax-free growth, tax-free dividends, and tax-free withdrawals in retirement. It's the most powerful account available to American dividend investors. 3. The taxable brokerage account is your overflow account, funded after maxing your Roth IRA. Use it for tax-efficient low-yield dividend ETFs. 4. Match your ETF to the right account. High-yield ordinary dividend payers like JEPI belong inside the Roth IRA. Lower-yield qualified dividend ETFs are most tax-efficient in a taxable account if needed. The priority order is 401k match first, Roth IRA second, taxable brokerage third. Follow this sequence and you will never leave free money or tax efficiency on the table. Action you can take today. Go to fidelity.com right now. Click open an account. Select Roth IRA. Start the 10-minute application. You do not need to fund it today. Just open it, because you cannot contribute to an account that does not exist. If this gave you more clarity on the account question than anything else you have read or watched, please like this video. It genuinely helps other beginners find this content before they spend years investing in the wrong account structure. And if you are not subscribed yet, one tap. New video every other day. Honest, clear dividend education, nothing else. That you have the right account set up. The next question most people ask is, wait, can I actually pay zero taxes on my dividend income legally? The answer is yes, and it is not a loophole. It is written directly into the US tax code. In the next video, dropping in 2 days, I break down exactly how to legally pay zero taxes on your dividend income, the specific income thresholds, the qualified dividend rules, and the account and investment combination that makes it possible for more Americans than you might think. Click the next video on screen right now if it is already up. And if you are watching this early, subscribe and hit the notification bell so you do not miss it when it drops in 2 days. I will see you there.